Okay, this is real life learning, real time learning. Pay pulled SEC is going to show you Edgar for a second. Hey guys, look at the URL. Write down the URL. Write down the URL. And the Q is the quarterly, the K is the annual. They file 3 Qs and 1 K every year. 3 quarters, and then the auditor doesn't audit the quarterlies. The auditor is associated to the quarterly. It's different. Oh, stop there. They wanted to see how XBRL looks. I was going to get another set of slides, but this actually shows how it is. You want to show them how it is? Yeah. She just opened it in Edgar. And look up there. Donnelly is the one I mentioned. Instance document based on XBRL 2.1. Edgar Online is the company that Donnelly bought. I was a director of Edgar Online before they got bought off. Okay, and they are the generators. They created the document. And the thing for you to understand is always this thing here. This is closest this. So, variable, result of legal proceedings ID. Closing, result of legal proceeding ID. And these are the tags associated with decimal 7. The number is here and etc. And you know, when the XBRL guys were trying to sell this, they used to say, XBRL is a computer language that can be read visually. And it can't. This thing is not visually readable. You know, you have to know quite a lot to interpret it, and is pretty complicated. Okay? But it's always like that. This is US GAAP, standard product warranty accrual. Okay? And close bar, US GAAP, standard product accrual. So what they can do is a hierarchy. They can describe the company on the top. This is basically the company description. And down here, so if the information will be repeated very much here, they give it on the top. Okay? To avoid repeating everything very, very many times. But each one of the variables starts with the definition and finish with a slash right definition. So the compiler knows that it is. Yes, okay, Sana. All the companies subject to SEC reporting, but XBRL has a kind of pardon clause, or smaller companies, they don't need to do it. I don't remember exactly what the threshold, because they just changed it. And it went kind of, XBRL went a set of implementation. First, only the main filers of a certain size needed to do it, and they only did balance sheet, income statement, funds flow. And then they had to do the footnotes and some other stuff. They are programs, like Fujitsu has a program, and several other companies have programs. And what you basically do, you pull your financial statement, either in a spreadsheet or in a PDF. You point to the variable here, and then point it on the taxonomy, and then it will create it in XBRL. It's kind of little aid. I had a PhD student here, and this is very early days of XBRL. And I had her prepare a company financial statement. It took her about 2 days with the Fujitsu tool. And so it's pretty easy to do it. It doesn't take too long. I could think that you could write AI-based system that would kind of interpret most things right, but something would come out wrong. Just, can you show I don't think in Excel, she can show you in the 10K itself. Yeah, there is a way to import it to Excel, but I don't think, we didn't prepare it so we can show you at this moment. We're just extemporating because you were interested, so we wanted to show you this.
Yeah, you can see those reports. In most cases, you will see the reports like a quarter report, annual report, and the company inventory report. Let's see. We already opened.
He called it interactive reporting. And so people had this idea that they could really interact with the data. But no. This is exactly the same paper data. But it's more the paper data on the 10K than the paper data on the financial report, of the company. The 10K is a little bit different from the financial report because there are certain things that the government requires that the company doesn't want to put in the financial statement. Like, for example, some companies don't disclose in their financial statements compensation of executives. But that's required on the 10K. So there is a little bit of a difference there. But you know those Yahoo Finance and Google Finance and etc., they actually organize it better. It's easier to look and etc., etc. If you've never seen that, next time I'll show you maybe Fidelity or Yahoo Finance, yes. An XBRL file on the 10K. You just go to the search that she went. Hold on a second. Okay, here is IBM. Okay, you see, look at this. This has the example of IBM. IBM Credit Corporation, IBM Financing, IBM Credit LLC, receivables, IBM International Group Capital LLC, retirement funds. So all kind of different organizations that you have. Pei, how did you get to the XBRL statement here? I am trying to go back to your path here. I've never done this, so I'm letting her do it. Okay. Okay, there she goes. If you have your computer open, try to replicate this so you learn how to do it. No, very good question. One of the things that Chairman Cox decided is that the XBRL statement did not need to be audited. And of course, the auditors were bent out of shape. And our committee actually did a whole committee on auditing XBRL statement because they were thinking it was big bucks there to audit it. And but the SEC decided they are not to be audited. They are not necessary to be audited. I kind of tend to agree with the SEC. The information on the 10Ks is exactly the information on the regular statement. And to check if the XBRL statement was created correctly doesn't add a lot of informational value. But when I say that in our committee, people go very bent out of shape. And also it's kind of a bizarre thing because they were thinking about 400 or 500 hours engagements to verify XBRL statements, and took my PhD student to create the XBRL statement WR Grace, took about maybe 2 days, 10 hours. So here it is, you're billing 500 hours for a work of 10 hours of the company to verify it. So it didn't make a lot of sense to me. But they created guidelines. We created a thing called principles and criteria for assurance of XBRL statements. And of course, they are picketing, or they're trying to get the government to require that. No, they don't. In the XBRL, they are totally out of it. They don't get involved. So did you understand Stephanie's question? I say your financial statement is audited. Is your XBRL statement audited? And the answer is the SEC does not require it. Good? Let Michael wonder about this. Maybe Michael will start the next class giving us a little demo of how to import XBRL into Excel, and in the process, I will learn it too. I haven't done it for about 10 years, so This is very good. So guys, let's have a couple of clicker questions here as a recap. Okay, you want to do this? I have a present for you. So what is the answer here? Hey, good. So the answer is E. Is here the B? I would say E, correct? Which one would you say? A, for sure, is a compliance exercise, correct? Meaning, is compliance, you have to comply. It's the law of the land, for sure. B. Yeah, you think processes, correct? Because you are thinking of transmitting data instead of manually, electronically. Now, why does it reduce risk? Because you can monitor better the data.
Yeah, automatic.
Okay, so it's D, not E. Yeah. Yeah, it's standardized. Yeah. So I guess she's right. I think it's E. XBRL is a representation language, correct? So you can put in XBRL any tag you want, correct? So you can put company metrics instead of putting, and actually financial account data is company metrics, but you can put any kind of company metric you want. Okay, you can use XBRL GL, so you can do event-oriented metrics. GL is a standard, more oriented towards lower level type of report. 3, accounting and cost. Remember, I represented accounting information. Part of it is cost information, cost of goods sold. Tax information. Several tax entities are using the XBRL and XBRL dialect for filing. Australia is doing that, the UK is doing that. Inland Revenue Service in the UK. Okay, and what I was trying to do here in green, which is a little bit of a fiasco, is talking about the main elements of XBRL. That is XBRL standard. There are XBRL, what they call instances. And what is an instance? It's basically IBM in XBRL, Apple in XBRL, etc., etc. So picking up a report of a company and creating that report in XBRL. The third thing is the taxonomy. And what did I say about the taxonomy? Is that the taxonomy is a chart of accounts on steroids. Basically, a large number of accounts so you can find exactly your name in here. And then these accounts have another level that basically give you formulas associated with it, or maybe limitation has to be larger than 0, etc., etc. So it's basically a chart of account but has some numerical capabilities to it, maybe a hyperlink, and that's what I showed when I was showing you the different languages thing. It's just an etc. And the one thing that we didn't talk about is a thing they call style sheets. And the style sheet is basically, if you have the information, you can define the variables that are on that style sheet. So you want to create a cache style. So you basically say, I pick up this variable, and I pick up this variable, and I pick up this. So it's basically creating a special report out of the data that you have. So there are the kind of 4 main elements of XBRL. The standard itself, instances. This is what you're trying to create, the instances. Then there is a taxonomy, which is the chart of account from which you draw your accounts. And finally, a style sheet, which you're not going to use very much. But the one thing I didn't mention on this is that, you mentioned it yesterday, this thing called extension taxonomies. And what is an extension taxonomy? Is when you don't find your account name on the taxonomy, you can create your own personal taxonomy and post it. Okay, and I think in the long range, these things are going to not disappear, but reduce a lot. Because there is some kind of innuendo that if your account no one uses, you are trying to not be transparent, not to be comparable. So there'll be some pressure for the elimination of extension taxonomies. But if you start thinking about this a little bit deeper, just a generic idea that there are 15,000 potential accounts, it's kind of unyielding, doesn't make sense. I am a great advocate for creating a standardized chart of accounts for each industry, and that's it. I also am a big advocate for no consolidation. Report each company separately, each of your subsidiaries. Why? Because adding a bank to industrial to a service company makes absolutely no sense and just obscures the number. And that's why companies love consolidated statement, because you can't dig out information. And no one likes to be graded. Right? No one likes to be graded. And this is back to the conversation that I talked. Technology and economics. And that kind of macroeconomics, policy type of things, and there's the micro of your profitability. And the constant gaming of this is the public wants to know. Companies don't want to tell. Companies don't want to tell for two reasons. One, to keep their competitive advantage, and in some cases to obscure management inaction. And the other one is very legitimate, is litigation fears. Okay? There is no other country even half as litigious as the United States. Okay? The US per capita has 5 times more lawyers than any other country by far. Okay? So this is a very litigious company, and if you disclose something, you always have the danger of someone saying that was misleading and suing you. Now, so the trade-offs for giving information to the public, which maybe you are being nice and you want your stockholders to know, are much worse than in other countries whereby you tell the public things to make yourself look good. But you are not sued. So you can't take chances. So there have been a pile of studies comparing disclosure in the US and in other countries, and voluntary disclosure in European countries is much, much larger. Okay, and you know, nothing is kind of unambiguous. You know, there is some arguments even for the US litigiousness, but in general, not so good. So I showed you a little bit of continuity equations. I showed you a little bit of clustering. Yes? Yeah. Companies do that already, some. They don't do this kind of advanced analytics that we're talking about, but they usually pick up the general ledger, okay, all the entries of the general ledger, and they do some analytics on the general ledger. And what they actually are doing, and they don't like to talk about this, is they send it to India. Okay, and why do they send it to India? Because labor is cheaper there, and the set of tests that they run and the analysis they do is pretty kind of run-of-the-mill type of thing. They are very secretive about what they do. And they are secretive because, first, you are paying very big bucks per hour for auditor, and so you are not very happy that you send to India with your data. That's the first thing. That's the one thing. The second thing is these are audit tests, and sometimes you don't want the auditee to know what you're testing. Okay, so there is a legitimate reason. Yes, Namita? Yeah, so that, very good, Namita. All the four big four are doing this, and I think the two plus also doing this. They outsource to India, but then they discover that the clients say, I'm paying big bucks to use KPMG, how can they outsource by that? So what they did is they created the KPMG India, some kind of subsidiary there. It's basically the same thing, but they gave it but it's the same name. And that way, there is a little bit less resistance of the client. But remember, for the general ledger to go under analytic evaluation, they have to have electronic copy of the general ledger in a readable format. So they actually would benefit from the audit data standard for general ledger, because then they could run a standardized set. But what's the problem about that? That commoditizes the business. What does it mean, commoditize the business? Makes the business cheaper, because you can run it to everyone. Okay, everyone can do the same tests. Okay, Professor Vasarhelyi can develop AI-based tests and use in the same thing, and it doesn't charge $500 an hour for partner time, or $1,000 per hour partner time. So that's a problem of standardizing, commoditizes the business. And none of you wants the business to be commoditized, correct? Because of the fat salaries you're going to make. Yes or no? You don't want to commoditize, do you, Namita? Namita only wants to commoditize if she's going to be the chairman of KPMG India. Then she's outsourcing, so maybe she's chairman of the people that outsource it in India. Okay, I mentioned process mining, and I just wanted to kind of discuss this a little bit more. Okay, we have the ERPs that we talk so many about it, and the ERPs have these different applications around the database. this application around the database, each one has their process. And I do to you a little chart where I had different processes. And you are flying transactions across the processes until you finish the process. Each process has a layer of controls around it. And each ERP creates logs of the transactions. A log of the transaction say, I saw transaction A, I did this to it, because my module does this type of thing at certain time, and the approvers were Jeremy and Namita. So it collects information specific to that type of thing. Now, this is very similar to the old idea of a management log that used to exist in paper documents. I picked up a paper, I did my addition, I marked my initials on it and passed it to Jeremy. Jeremy did his approval, evaluated, signed his name, passed it to Oksana. So next to the document there was a log of what happened to that document. It was a header of a purchase order, was arrival document on a warehouse. They were documents. And then you picked up the arrival document in the warehouse, the purchase order, put the two papers together, see, does this match that? Did my guy in the warehouse sign that he received those parts? Yes. So then I am Jeremy, I signed this and I signed this. Staple them together, put it in my files. Is this true, the way they used to do this? Yes. Not only true they used to do it, they still do it. Yeah, they still do it. They still do it. And you know, you don't want to pay for something that you didn't receive. You want to make very sure that Jeremy didn't order something for his girlfriend instead of ordering it to the company. Okay, you want to make very sure that you didn't order bananas, you got apples. Okay, so these are all these, this was a management log. There were actually signatures associated with it. When we went electronic, the signatures disappeared. The visual evaluation disappeared. And there is a computer program that matches this against that. And so the number of manual entry errors went down because you don't keep transcribing the same information. But the scrutiny disappeared. It's possible that you receive an apple and you write it as an orange and no one sees it. So that's what changed. And what this also permitted is tracking transactions electronically. And this hasn't been done. We are just in the process of publishing the first paper in auditing on this thing. And the idea is, what I said before to you, is that we are going to look at the path of the transactions, which is a different form of evidence than the other type of evidence we did. Okay. Parenthesis here, and let's just talk for a second about what is said in the first class. We talked a little bit about big data. Is what is audit evidence? It's things that you pick up to support some kind of audit assertion. Assertion that everything that we received in the warehouse was actually ordered with a purchase order. Okay? So the flowers for Jeremy's girlfriend were not in a purchase order, so they should not be being received. Okay? So that's the purpose of these processes, are to verify that there is integrity of business. And you have to think of these in values of documents, and at the same time, you need to think about this as a process flow. And at the same time, you need to think about this as metadata, as data about data. All of these things come together in a story. So what the slide shows is you have an invoice number 003, supplier AT&T, posted date in 2010. And then you create all kind of information associated with the flow in the system. So this is same kind of thing, plus what is this? Create an invoice. Timestamp, February 12, 2010 at 8:33 a.m. Originator, Jeremy. Value, description. Some of that get posted, some gets added here. And then there was a change. The value actually is not 100, it's 120. So the field change value and the signature, originator job. So what this finish up being is a fruit salad of things that came in the original document and things that were added at the flow of the document. What did I say in the first day of class? That audit evidence is changing. And the example that I used most was what? I use RFID, I use GPS. And what I said is you get much better evidence following, tracking inventory than going and taking count of inventory in a point of time. And in old days, this has not changed, technology. And therefore, in old days, you could not do it. But now you can. Now the question is, are you going to collect the data or you're not going to collect the data? The other discussion that you have is that these things exist in many companies today. But you guys, auditors, are not using it. Why? Why aren't auditors using this? Because no one told them to do so. Okay, there is no standard associated with it. And by the way, external auditors work on a very tight time budget, so they only do what they're required. Now we're talking with one of the big four, and they are pretty bent out of shape about the PCAOB. And the PCAOB does these, now they became very active on audit examinations. And what is an audit examination? Is an audit of an audit. And so they pick up, based on risk profiles, certain audits that the Big Four and the Big Six did, and they check if they did what they are supposed to do. And the PCAOB is obsessed with samples. So they want physical samples, like 50, 60 out of a population of 1 million. And several of the firms got slammed in PCAOB audits by not pulling enough samples. So what this firm is telling us is, let's humor the PCAOB and pull the samples they want. But we need analytic methods to tell us that the population is well stated. So this is what anachronistic legislation does for you. Makes you do things that doesn't have any real evidential value. And I think this is what's going to be happening. We're going to pick up much more evidence in the form of electronic evidence, but we are going to live with obsolete anachronistic regulation. I talked to the PCAOB last week, actually, and I said, you guys have to do more analytics, et cetera, and say, well, we are in a task force looking at technology. Tell us what we should look. So we are collecting them, a set of academic papers, and give it to them. But, you know, they're not going to read it. But maybe we could come up with some kind of cookbook of things that they could do. But it's not my job, correct? You say it's my job? No, it's not my job. I don't publish a paper out of it, so why would I do it? Pei won't publish a paper out of it either, so she won't do it. Okay? But that's PCAOB needs to go and look at the economics of the situation, technology of the situation, and reorient what they are doing. And I think once I talk about new forms of evidence, and the new forms of evidence that I talk most is GPS data, RFID data, social media data, and process mining data. And I have been talking about one for a long, long period of time, which is alerts. Alerts in a continuous monitoring system. And if you look at all of these things, they are not in the standards. And I asked you before, why don't auditors use them? Because they are not told to do so. And the mentality has always been, we only do what we are obliged to do. The problem is that without this evidence, you are not going to validate assertions very well. Without this type of evidence, you won't be able to validate 26 million credit cards without putting some pretty good analytics around it. And if you're going to pull a sample of 100 of the credit cards, you are not going to find out absolutely nothing. And so that's the dilemma that we are living today on needing to expand the scope of evidence on the audit. Now, our PhD student, Ryan Teeter, who is a professor at the University of Pittsburgh now, and Don Warren used to be a professor here, and before that he was a senior partner at PwC. Before that he was a partner at Coopers & Lybrand. And he was in charge of technology at Coopers & Lybrand. Okay? And Don, I mentioned Don before. I said when we went and created the Red Book, he's the one that was in the committee for the CICA and invited me to participate. And he's now a professor at the University of Hartford. And we continue working together. But they started looking at the technology of audit. And they say, we are kind of changing the way we do audit. And we are trying to look at auditing remotely. And the process is to reduce the delay on the audit. You need to interface with the client, and it collects evidence. Now, the problem with the law, first, there is much more auditing done from your office than in the past. Okay? And if you observe how these audits work today, and we've done a pile of those, what you call fly-in-the-wall studies, whereby we just sit around and listen to what they are doing, what you realize is that they apply these internal control questionnaires, they raise issues, and now what they do is get a lot of documents by email. And they put it in these document management systems that they call electronic working papers. And when you think about electronic working papers, what you think about is a big spreadsheet with basically different colors and which link to observations and et cetera, et cetera. And those still exist, and those are, interestingly enough, they are done in Excel with hyperlinks. But actually the large amount of documentary evidence is a copy, electronic copy of an email or electronic copy of a report and et cetera, and they just keep asking for these reports and slam it together with the evidence. It's not like an intelligent set of working papers. There are things like Paisley have a very sophisticated electronic working paper thing. PAWS is another one. And there's a pile of these things. You are going to have a chance. I have to ask Rod to show them in the advanced auditing. You might see that. Maybe even Helen will teach you in the audit class some of these things. But these things are really kind of very primitive. They are just kind of spreadsheet and some documentary saving evidence. And in reality, what you want is a exception reporting, audit by exception, live system that has a dashboard and calls your attention if big anomalies are happening in the system. That's what you want. But these things are not even close. I actually was in a Kansas conference maybe a month and a half ago, and the vice chair of PwC was there, and he was saying that this is time to go to a new set of documentary support to an audit. And he said exactly what I said here. I was actually surprised hearing them saying that they are doing. And I know that 3 of the 4 firms are doing the electronic system of the future. And I wouldn't be surprised if you guys start interviewing with them next semester that they'll mention it. And unfortunately, most of the people that recruit are pretty low level in the firm and don't know these things are happening. Yeah. That was exactly the argument we did in the second XBRL meeting in Philadelphia, is that what you really wanted XBRL tagging to do is, remember I had these 3 elephant paws. I called one labor, the other one materials, and the other one services. And these would be transactions of that nature that would be tagged. Remember when I talk about symbolism and etc. And what we wanted to be able to do is transfer from this directly to XBRL. GL, which didn't exist at that time, was the idea of tagging at the transaction level. So you didn't have to interfere, because what actually happens is this doesn't happen. And so this information gets, if it comes in XML, it gets detagged, gets placed in relational databases, and then gets manipulated, etc. And then large part goes to company ERP. Little part eventually is an output to financial statements. And then you retag, because you are required to retag. Did I answer your question? Okay. So when we are doing this type of thinking about audit automation, you started thinking about what you're doing in an audit. And Ryan's big shtick here was about remote auditing. Now, one of the problems of assurance in general is that the auditor is the general that comes in after the battle. That's one story. The other problem is that you forget about the auditor. And what you want out of an audit is detecting anomalies, but you also want a deterrent effect. What is a deterrent effect? It's an effect that people do not defraud or make mistakes because the auditors will find them. And if you do it once a year, they forget the auditors exist. So the idea of Ryan around this was, let's have the auditor on your face, even if you are not on your face. And it's impossible to be an audit location all the time. So you put some algorithms working for you and work around the exceptions that he picks. Okay. And what is a meta information? Meta is information about information, and could be meta, could be meta, information about information about information. And for example, XBRL collects metadata. What does it mean? It looks at the data and looks information about the data. Now, the NSA was collecting information about you. And they say when the head of the NSA was inquired in Congress about metadata, about data that were collected, said, we're not collecting information. We are collecting metadata. Is that true? They are collecting telephone numbers and kind of in a very remote thing, they can say, yes, that's metadata, because the real data in the telephone call is Inya talking to Oksana. So the words of that interaction and the tones and et cetera, are the data. And the metadata is telephone numbers, duration of the telephone number, and the two telephone numbers, the callee and the caller, or the people in the conference call. But really, all their analysis wasn't about the conversations, was about the numbers, because they didn't have the conversation. And the analysis, what they were doing is the thing that I'm going to show you here about social network analysis, inbound, outbound calling, and etc. This is data analysis. Meaning metadata is a little bit different from that. So, you can interpret it in different ways. But what Ryan says here is you have these audit repository, data field collection, manual evidence, and then you can have something like CRMA, meta risk management. You can have CCM, which is control management, and then you have a process management with the data itself. So, it's another way to do things, although this is a conceptualization that doesn't have a lot. Now, changing topics, let's talk about predictive audit. This is extremely popular at this moment. Every time we talk to a company, they want to do predictive analysis. Several of them are doing predictive analysis. Give me what the basics of a predictive audit is, as opposed to a retroactive audit.
Based on the past 5 years, the company be able to gauge the sales or performance or net revenue based on previous history.
Good. I couldn't have said it better. Just visualization for you always like it better. You have the data of first quarter, second quarter, third quarter. Now, in the fourth quarter is when your annual statement, the 10K, needs to be issued. And you have a window of about 3 to 4 weeks to perform that, because the SEC requires in Sarbanes-Oxley 6 weeks publish the report. So you have to give your opinion and give it a couple of weeks for them to public relation, clean up the data, publish it, get the people like Donnelly to publish the data, and et cetera, et cetera. So they need time. Actually, the people tell me it's more like 3 weeks, 2.5 weeks than the time that they really have. So, an idea of a predictive external audit is you use this data, and maybe taking Jeremy's approach many years, create yourself a model that predicts to you what this is going to be. And if what management tells you that this is reasonably similar to what you predicted, you don't audit. You say, I have sufficient evidence to conclude that this is correct. You like this or you don't like this? Why not? If the black swan is a third quarter, fourth quarter black swan, you don't. Hopefully you pick up tertiary evidence. You pick up other things, other correlated variables that tell you that the black swan is helpful. And actually that's exactly what we try to do with CRMA, because we do operations, we do environment, and we think that these risk factors, the KRIs, are correlated, that by looking at what's happening with these, you look at during the financial crisis, Bear Stearns, there are a lot of variables around correlated that were indicated the potential run on Bear Stearns. Black swan is a bad event that happens very, you read this professor, what is the name of the guy in NYU? I'm just blanking his name. He wrote a book called Black Swans, very, very popular. I'll give you next time. I'm just blanking his name for a second. And this is a highly influential, unexpected event. Now people say, if it's unexpected event, how can you create a KRI on it? And the answer to that is you can think that an event may happen, but it's probabilistic so unlikely that, but it's so destructive that, hey, just do a black swan there on Google. Huh? Natalie Portman? I like her personally, but that's a different story.
Black Swan NYU?
Yeah. Yeah. Naheem Salam. Oh. Yeah. And he's the guy who predicted the crisis of 2007, 2008 on systemic basis, and he became very famous, very popular. But that's what but it's really the black swans is a whole set that are high probability, very low probability, very high events. So the expected value of it is reasonably low because the probability is so low. But you can imagine things that are going to happen, like a tsunami in your nuclear plant. Okay, you can say this could happen. There are, every single business have hundreds of very unlikely events that could happen. People could commit suicide out of the higher tower. Okay, there could be a terrorist come in with bombs. But if this is in Lebanon, it's more likely than if it is in Midtown, Georgia, or Mid-City, Georgia. So, all these things are balanced around these things. But in the more likely of these, you try to quantify them. And there is a correlation across risks. Still, to be candid, I always think these are kind of a witchcraft experiment. You can't really quantify very well. I'm not very interested on these. I'm interested on things that you can measure and you can do something about. And one more thing. I don't know if you've seen this literature. There's a whole literature about people perception of risk. And actually, people perception of risk is very, very different from what actual quantification of risk tell you. The one I always use is people are terrified about guns in their house. I really don't like guns in general. Okay. When you see one of these crimes around it, you get, I didn't like guns very much. But if you look at the statistics, it's 10 times more dangerous to have a swimming pool in your backyard to your kids than having a gun in your house. Okay, and I could give you tens of these. There's a book called Freak Economics by Levin, not Levin? Levitt, yes. And this book, there are actually two of them, two Freak Economics books. One, and they discuss prostitution in Chicago. They discuss the schools in Chicago. They discussed a swimming pool in your backyard, and etc. And basically, I think he shows pretty clearly that the perception of risk is very different than the nature. Write down, I want to send them that article on risk perception. There was another one I want to say. I can't say. But back to Levitt. Actually, Levitt, interesting story. He wrote this book, Freak Economics, was very popular about a few years ago. And it's basically about personal economics and perceptions of risk and etc. And was very popular. He got several awards in economics in the University of Chicago. And then someone reanalyzed his data, and he was full of mistakes. And this happening more and more in academia about bad analysis. And you don't know if it's bad analysis or you do so many analyses that you screw up a few. It's just the probabilities of screwing it up. But yeah, he got a very black eye out of this whole thing, but he made a lot of money because his books sold. And he's a tenured professor at Chicago, so it wasn't bad enough to take his tenure away. So he's still there. He's there. And by the way, if you have the chance, read it, because particularly first Freak Economics is very, very good. His big story on that one that he made, that made him notorious, was the story about crime and abortion. And what he basically said, that his equations have proven that what changed criminality in New York City was the fact that abortion was permitted by the Supreme Court, Wayne versus Wade. Roe versus Wade. Okay. And the argument, the logic follows to a certain degree. If a lot of unwanted children didn't come to the world, those unwanted children won't be cared enough, and they won't be brought up by good mothers, and they will become criminals. The numbers, according to him, prove that. When some people recomputed his numbers, they were wrong. They didn't prove anything. Okay? And that was very controversial at the time, but the rest of the book is very good. Even that argument is an interesting argument to think about. Just because someone is not right doesn't mean that you can't think about their ideas. Okay, very, very interesting economics type of discussion. And both of the Freak Economics, the prostitution in Chicago argument, whole discussion is very interesting, is well done. And he has a lot of discussions about, because, school children are tested a lot, and school children have a lot of statistics on. So he does a lot of economic analysis on the micro level of education and et cetera, et cetera. They are very interesting. It's worth reading. Yeah, well, it's not only that. In Brazil, they created the thing called salário família, family salary. And what that is, in the most poor families that don't make $1 a day or something like that, they actually giving them something like $600 a year to keep the children in school. And if the children don't go to school, they don't get paid. And about 2 million people receive it in Brazil. And has been incredible effect on distribution of income, because that the tail end of the distribution of income pumped up because they started getting $1 a day or something like that. And supposedly the education effect is good. Supposedly, because the same kind of Levitt story, people are contesting the statistics. But I tell you what, it convinced a lot of countries because it's being copied all over, including in Arab countries and including in Africa. Okay, they think that, and if you start thinking that those you saw those income distribution things that I showed you in the Hans videos. Okay, if you change slightly, that was a logarithmic scale, 0, 1, 10, 100, 1,000. So people look much richer than they were, correct? Because if that was a continuous scale, then it would be much flatter. There would be a much bigger distance between the rich and the poor. Okay, I kind of don't like that of Hans Rosling, although I love his work. That would be different. But if that little tail end went up, the whole thing would have changed quite dramatically. So actually that kind of analysis and that kind of program is very interesting. And I don't know if the Brazilians looked at Levitt's work. I don't think so, because that was done earlier. But it's very, very interesting thinking about it. So back to the predictive analysis. The idea of predictive analysis is you use audit data or kind of historical data to predict the future. And in some of them you take action. Some of them you just confirm what you found. And I usually break auditing the following way. You have retroactive audit and you have predictive audit. Retroactive audit is why I was joking that I say is the general that comes in after the battle and shoots the wounded. Predictive audit does analytic methods to predict. Now, there is the predictive preventive and just a predictive. Okay, predictive. And what is the difference with that? If you create a filter just to pull exceptions, you are predicting. If you create a filter and block events from happening, that's preventive. And then the moment you start talking about predictive preventive, people start saying this is not auditing. Because now you are in the process. You are not an observer of the process. And that's the kind of dilemma we always find ourselves in continuous audit and analytic methods. Is this argument, is this audit or is this not audit? People say this is a control, okay, a meta control, a control. But what is auditing? Is a control. And why didn't we use it preventive or predictive audit in the past? Because the technology, analytic technology, and the data technology did not exist. You couldn't do it, even if you wanted to do it. So now that you can do it, you have to decide if you are going to do it and why. And what are the economics of that? And of course, there will be the whole forces. You don't want to be audited, you want to be audited. Society needs more auditing. People want to make more money, so they don't want to be audited, and et cetera, et cetera. That's the pull that's going to happen. But audit looking backward has some value because it, in the Security Acts, before Security Act, there are a lot of companies publicly traded that didn't exist. So at least you know the company exists. That's good. And then you pretty much know that they do what they are supposed to be doing. That's pretty good. And you pretty much know that is the size that you think the company is. There are stories like ZZ Best. This guy had an entire company listed, audited by the big six at the time. Company didn't exist. It was just a little marketing thing and was a big share. Okay, and this is not the 30s. This is the 70s. So it's good. The company exists, is doing what it's supposed to, has the stores it says it has. And so it's not, as I say always, auditing retroactively is not totally useless. But the numbers they are certifying to, except for cash receivables and payable, are useless numbers. No one uses to run their business those numbers, particularly goodwill. Goodwill is a total aberration of a number. It's not worth the day it was written down. Stephanie says, how can you say that about my profession? Goodwill, what is goodwill? It's kind of a residual number of that you paid more than the book value of the company, correct? And maybe maybe I exaggerated. Don't take offense. Maybe it's worth for a minute by the time that you wrote. I think that first year that you know the book value was it. The book value represents very poorly the physical assets a company has. And the two big things there is property, plant, and equipment, and inventory, correct? That's what the book value of a company is. It doesn't represent the intellectual value of Danny. It doesn't represent the huge investment you made in supply chain. It doesn't represent the huge investment you made in brand. Okay, you spend millions of dollars advertising your generic, I'm IBM. Not what I do, but I am IBM. That's an investment and helps, or they wouldn't do it. That all not represented. Other thing is I invested in new products that I'm going to sell over 20 years. However, I cannot capitalize my R&D, only in very remote production cases. So that was expense, so that doesn't represent either. So they are bad numbers in general. And there's a difference between what you paid, because in your mind and in the markets, your production is worth something and people value these things, in relation to what your physical assets are poorly described by LIFO, FIFO, and market value and whatever. And so that's what goodwill is. And it's a cumulative set of goodwills you add together. And you can amortize some of it. So it's not very useful. Okay. But I think these predictive numbers should be published. And they are very interesting. Very, very interesting numbers. And again, we go to the discussion that you guys so energetically discussed against me, and I liked it, which is these are bad measurements. And a bad measurement is an interesting thing to think about. Because a bad measurement that gives you a little bit of information is better than no measurement. But a bad measurement that gives you negative information, disinforms you, is not pretty good, correct? And these are very difficult judgments to make, and that's why you have GAAP. That's why you have standards, because I think it creates a baseline of things. But unfortunately, GAAP didn't incorporate human resources. There is a whole area called human resources accounting. Okay, and now there is the sustainability reporting. And then you are going to hear from my friend Brad Monterio talking about integrated reporting, when you bring these things together. Okay, and you're going to say, this is voodoo land. And it is. But the question is voodoo land more informative than no voodoo land? Yeah. No, if I had my way, I would establish standards for everything. For human resources, for supply chain, for etc. I would tell SAS and SAP, and why did I say, say SAS, SAP and Oracle, why would I tell them? Because that's what the Dutch did. They picked up the 7 largest software firms and told them you have to create reports this way, with XBRL in this case, preparing the data this way. And so everyone had those reports prepared. It was very cheap for any company to go in and do it because they already buy that software. So that's what I would do. I would tell Oracle and SAP, say, you want to sell in the United States, you have to prepare these reports. And what would happen in general is that most of the information they would already have in their ERPs, but not all. And they would have to create new fields, and the new fields, they couldn't do it retroactively. It takes too much money. So they would start collecting when things happen. But I bet you, and I haven't done a study on this, but I bet you that a lot of the information is in there today, because the information that's useful is the information that you need for managing your business. And that information they are trying to collect because they want to sell the system. Sounds a little bit theoretical, but it's the way it is. Okay, so actually, we talked about predictive audit. I just want to show you this. This is Siripan's study. And she got a PhD. She's a professor in Thailand in the Chamber of Commerce University of Bangkok. And what she did is she picked up data from sales of products by bank branches at Itaú Unibanco. And she was trying to predict a thing called merit sales. And what is a merit sale is when Danny is my branch manager, and I said, Danny, I want a loan. And then said, no problem, I'll give you a loan, but you have to get a credit card, you have to get a PIC product, and you have to get an insurance for me too. But no problem, you cancel these transactions as soon. Because why does Danny does that? Because he works on commission. And he actually doesn't get commission percentage of his head, gets points for a trip to Hawaii. Okay, like Hawaii, correct? I like Hawaii, I got married in Hawaii. And so that's what, so we're trying to detect the transactions that have the behavioral characteristics and the nature characteristics of married sales. And she used 3 different, very complex analytic methods: logistic regression, J48 is a decision type of thing, and support vector machine. Okay, and then she measured in different ways: accuracy, false negative rate, false positive rates, and you know what these things are. Now, do you remember what Paul was talking last time? Paul was pretty clear what he wanted to say, although he was very elusive about what he was talking about. But he says, I'm going to talk about how to evaluate these models. And so this is her evaluation table. And her prediction, the best she got, was 79%. And very low. And you know, I gave her dissertation, we signed, she's very happy out there, published 2 articles on it, we are very happy at this. But finally dawned on me why the results are so bad. At that time I thought they were okay, but since then we have seen, we are doing a study for Itaú on litigation. And basically we are looking at customer complaints and feedback from the customer until the point of how many of them sued Itaú in Brazil. And our prediction rates are 97%, 95%. And here, look what I have. Pretty weak. We've done 2 other predictive studies, all in the 90 percentiles, 80 percentiles. Turned out I finally had this guy cleaned up the data. He got rid of the outliers and gave us a very nice data set. Siri didn't have to do any data cleanup. The data was, she did all this examination, but she didn't have to do. Turns out someone had cleaned. I called him up. He works for the New York for the Brazilian Stock Exchange now, good friend of mine, I like him very much. And I asked him what he did with the data. He said, oh yeah, I cleaned it up and this and that. You needed clean data, correct? Well, meaning I tell you how clueless I was. I had no idea this was happening, that the data had been cleaned up. So I really would like to go back and I asked them, I said, can we have another set of data? And of course the data disappeared 5 years ago, so we can't get the data. So I asked them to recreate the data and they don't want to do it. They are not interested on married sales, so too bad. Okay, now this is what I was mentioning to you before. This is Youngbum Kim's thing. And this is manual entries. This is more than 2 branches related to that transaction. And this is duplicates. And so he had 214 duplicates, 1,900 double branches. He had 579 manual. However, the ones that matched 2 of these criteria were 5, 183, and 72. And this one matched the 3 criteria. So, what is this? Remember, was this thing here with the coefficient 1. Meaning we didn't say this is more important than this, more important than this. What we said is we can't, for every time these 3 events happen, we give them 1 point. So if the 3 happen, they got 3 points. If 2 of them happen, give 2 points. If 1 happen, you give 1 point. So this is the most simple form of probability estimation. Now, I'm going to complicate your life a little bit, go back to what Youngbum did. And this is actually looking at transitory accounts. And he had 16. What is a transitory account in a bank? I wire money to Joe. It can't be deposited in Joe's account because either his name is wrong or his account number is wrong. So it sits in the transitory account until someone manually reconciles it. Or maybe someone goes into the internet and the wire transfer is fixed. Okay. Now, all banks, all credit card companies, all electronic sales companies have transitory accounts. Because these happen. These things happen. Itaú, at that time, no, this was Unibanco before Itaú. Unibanco had a nearly materially wrong quarterly statement. 70 million reais had disappeared. Turns out that the 70 million reais were sitting very nicely in a transitory account. So no one has stolen, no one have absconded, someone just misposted. Can this happen? Of course it can happen. It happens very often. And so we had with this, sometimes, things are funnier than they seem. We had done a very extensive study within Unibanco of what we call reps, which were what projects could we do for continuous auditing. Make a ranking, met with managers, chose the ranking, go to the chairman of the audit committee. He went to school with me, so I know him very well. And he looked at that and said, no, you do transitory accounts. Had nothing to do with the list that we had proposed. Turns out that $70 million had just happened. So Young Bum is very smart and he's a statistician. So Young Bum says, okay, we are going to monitor transitory accounts. First, they didn't know who had the transitory. They had 10,000 accounts. They didn't know which ones were transitory. That was very difficult. For a month, we struggled with that. Finally, we decided, you know what? We are not going to look what are the transitory accounts. We are going to ask the different audit branches, give me 50 transitory accounts. So we came out with credit 50, this 50, that 150. And then we chose 16 out of them that we could get data easily and when our transitory thing. The second thing is the volumetrics of this thing. 70 million transactions a week. Put 2 lines of code in that daily processing, you blow their computers out of the water. So we couldn't do anything with the daily transactions. So what we did is actually is not here. We did what we call the 3-level study. First level, describe what were the risky accounts. Second level study is what we call high platform. In the mainframes, we collected annual information, daily information. So what transaction days, what account it was, what was the maximum, what was the minimum, what's the variance. Those information existed. We didn't have to recompute. And then Young Bum developed what he called the P rules. And the P rules is he looked at, now, basic statistics here you might not remember. There is this thing called kurtosis, and there is thing called skewness. And kurtosis has to do, is this normal distribution fat or skinny? And skewness, is it bent left or is it bent right? Bent left, bent right. Okay? And so he basically said normal is not normal, which is correct. And a lot of the studies assume normality, which is not very robust. And out of statistics, he came out with these rules of the probabilities that you should use to call a particular account bad for that particular day. And so what we did is when we violated the P rules, we picked up the entire account day, meaning that one of those 16 accounts, for that particular days, we downloaded it, and then we beat the hell out of it with data, because now we're not in the main processing of data of Unibanco. So that was Young Bum's dissertation. They loved it, and actually they would have put this in place, but they got acquired by Itaú. And so instead of being 1,500 branches, became 4,300 branches, and Itaú wasn't too interested in transit accounts. Believe it or not, I was in Brazil last month, or even early this month, and now they want to look at transitory accounts. So I have to find Young Bum and call him up.